Hello and welcome. I'm Ruchira and with me is Chirag. Today our guest is Sonam Udasi. He's Senior Fund Manager at Tata Mutual Fund. Now, with over 25 years of experience in equity research and fund management, Sonam has a wealth of knowledge to share. And today we'll be discussing the current performance and strategy behind the PE Equity Fund managed by him, along with insights into his broader approach to managing both this fund and the Tata India Consumer Fund. So, welcome, Sonam.
Thank you. Thank you.
Now, to begin with the recent volatility in equity markets, do you think the worst is behind us or should we brace for more uncertainty?
So I think from India's context, I would argue that a lot of the negatives are behind us. So there might be volatility. We are in a increasingly, ever increasing volatile event world. So I would not rule out volatility. But I think what gives me comfort is that a lot of your valuation bubble got burst in the last 4 months. So I would not say we are cheap, but you are now in the realm of reasonable valuations. And if growth starts to come back, then you can justify many of your holdings.
Sir, when do you see the meaningful recovery in the small and mid cap segments, which has fallen considerably in the last 4 months?
So if you look at it dispassionately, the small cap and the mid cap indexes have only fallen 16-18% from peak. There are some stock. So what happened really was in the last year, everybody jumped onto the bandwagon. So you saw a lot of SME hype, you saw a lot of small cap hype. It was basically a WhatsApp culture that somebody said something and you bought something and it went up. It was just money taking the price up. I think those days are not going to come back. Uh, but I do believe whatever was worth it, whether it was large cap, mid cap, small cap, and if there is a viable business model, they have already come back. There are many small caps that I wanted to buy or add more, and some of them are nearing their 52-week highs. So that's the kind of, so it's not about the market cap really, it's the quality of what you bought, and would it stand the test of time. So I think we are not in the, while Nifty is barely, some points away from whatever it did as high. Um, uh, the fact is that the sentiment that was prevalent, say 6 months back or 7 months back, that is not going to come back. I think there is realism in what you want to do. There are more questions being asked whether you're a large, mid, and small cap, and it's a good thing. It's a good thing. So qualitatively, only companies which stand merit would tend to go up and stay there.
So, sir, in a way, you are not expecting more fall in this mid cap and small cap segment going forward.
I think that the good companies within all three market cap baskets will continue to consolidate and keep doing what their P&L and cash flow will forecast. The others which had no cash flow or a revenue potential or P&L potential scale up, I think they will keep suffering, and at some point, you might face further drawdowns in some of them even today. So it will be you know, it will be an investor's market per se. Quality will sort of speak for itself. If you have a business model, even today, you're a small cap, you will tend to get higher valuation if you can demonstrate that higher growth. Um, I think that is truly back. It's already visible. And that is not only in Indian equities, that's happening even in foreign markets as well.
Right now, moving forward, can you walk us through your investment philosophy and how it has evolved over your 25 years in equities and fund management?
So I think the philosophy has evolved in the sense that it tends to be reinforcing more towards um, the scale of business and the quality of business. Over the years, what has been added is the layer of what kind of management, what do they think, um, how is the ROE, ROC profile of these businesses, is there an industry growth potential, there is an added layer of what is the geopolitical situation and how does it impact this business, whether it will remain relevant in the next 5 7 years, how competitive it will be. um, Also, while I do look at the ESG side of, what is the negativity around it, I do believe that bit of concern is somewhat lessened over the last few years. It may come back. But essentially, from a philosophy perspective, I look at only five things. One, what is the industry revenue potential over the next 5 years? What kind of companies are there within this industry? Are they investable, scalable? Are they liquid enough? Because as an institutional, uh, I might buy a bottom up, very small cap kind of story, but I can't buy enough to move the needle. How investable it is, how big I can, capture that and put it in the portfolio. That's more important for me. And also, what is the return profile of the business? How intense, what is the capex intensity of the business? And how many times are you going to come to the market to dilute me? These are the smaller factors that I look at and generally keep it that much. And if new industries come, keep looking at that and see whether you have enough representation, or do you want representation of these industries in the portfolio.
So it's a very broad term. Can you just explain a little bit on within the universe? How do you select the stocks in the portfolio? These are the bases, but how does the stock flows into the portfolio?
So I'll talk, say, I manage, say, three different schemes. So I run a value fund for the Tata Mutual Fund, which is the Tata Equity Fund, which is a different context. And then there is a Tata India Consumer Fund, which is the most expensive on a trailing P basis within the Tata universe. So there's the cheapest fund and there's the most expensive fund, and both have different mindsets. So from a value fund perspective, what you do is essentially, uh, as a start, I would run a screener that what is cheaper than the market today, what is cheaper than the index today. So for example, if Sensex trailing P is 22 times, and what are the stocks which are cheaper than 22 times today? So maybe I get a set of, say, 2000 stocks to talk about. Within that, I will say, okay, which are the industries today where I want to be invested in over the next 2 years, where the revenue potential or revenue CAGR is higher than, say, the Nifty or Nifty 200 as per my estimate. Then I will look at those industries and see whether there are cheaper companies within that. Can I find a cheap company within that? What is the ROE, ROC profile of these companies? Are they part of an index? Because it also tells me what is the level of liquidity in those. Like there, I might find, say, two stocks within the same industry. One is in an index, one is not in an index. I'll probably be able to buy a higher weight in a more liquid counter than. So those are contexts that you look at. There is also a turnaround thing, and you want to mix that up with something else. But ultimately, growth is everything. I strongly believe that investors come into equity from a growth perspective. It's not about value. I want value in a growth stock. I want growth. In the end, I want to become wealthy. I want to grow my wealth. That's why I have chosen equity. So you need to have a growth mindset. If the industry or the sector is not growing, or the company does not have growth aspiration, then the valuation will not follow suit or will not sustain. That is my underlying. The way I look at things is simply this. And if I can find a cheap company which is growing, that is my nirvana. Uh, you know. So that's how I'll put it simply.
Sir, in the past interviews, you have mentioned that you avoid stocks which are losing market share or have unclear growth paths. Are there any specific sectors or stock trades you actively avoid?
No, I think it's not sector specific, because there are companies within the sector that have these kinds of confusion in their evolution. Um, However, in company specific, I try and avoid. See, each company also evolves and goes through their own. So you need to keep meeting them. Uh, Generally, we like investors look at a fund house or a fund manager to take a call on. We take a view on the management, what they are thinking through, what they are talking about. So I might have a certain projection on growth on their industry, but they may have a different view. And if I think that their view is a little confused and I have a different view, then I would not want to. Or maybe I think that their view is better than mine and they sort of educate me on this, then I can change my view and move forward. There is no straight answer, unfortunately, that this will work and not work. You need to keep every day evolving yourself because world is evolving, the competitive landscape is evolving, geopolitical situations are evolving. But I always want to see whether you have a growth mindset as a promoter or not, and how do you want to get to that growth. If I can find a company which is growing within the cash flow that it generates, within the capital that it has, that's the best model, the simplest model for me to go because then the scope of mistake is very minor and it's quarterly that I can live with.
Are there any kind of stocks which you don't touch, or which you don't like, or you will never touch that stocks?
When I was younger, I used to say that this sector I will not touch, and over the years, I have realized never say never. Situations change, and in the scenario, like for example, if you had asked me 5, 6 years back, I would have said I would not touch PSUs, which is still true. I don't even today like to do, say, PSU banks. There's nothing about them I find relatively better objectives because the objectives of PSUs are fairly different than private sector. Their objectives are also public driven. They're, not only profit motive. My objective is to enhance the capital of my unit holders as far as possible. That's my objective. So if it doesn't meet and if I can find a better alternative on the private side, I would want to go there. Otherwise, there are like sectors like defense and PSUs, large defense order books, and only they have a large play within that sector. Then it makes sense to be in those names. Though I think private sector, if there was a private sector compatriot, they would have probably done a better ROC profile than them.
Right, now moving on to some fund specific questions. So Tata Equity PE Fund, it performed well from 22 to 24, but has struggled recently, landing in the fourth quartile. So among other value-based funds, it also struggled to manage the recent correction phase. So what do you think has contributed to this underperformance and how do you plan to address it?
So I think the underperformance was really because of three things. One, we were heavy on financials. It took some time to sort of come. While it did well, during the fall, but it did not help enough. There we also had exposure to, say, the power ecosystem. That though it was cheap, but it also participated in the fall. It actually fell as much as, say, mid cap company. So that sort of but I still believe that India is a power deficit state and the industry will grow from here. And you need to be in this ecosystem because there's a demand supply mismatch. There will be demand for it. And the stocks are cheap, there are dividend yields. So we still, while we took profits in some of these names at the peak, we have started adding some of it back again. Um, I think the way we are structured today within financials, we own some of the large banks. We also own the financial intermediaries, the financial services companies, the AMCs, some of the brokers. They are facing also because of the market sentiment. Their valuations are also have corrected and stayed there more or less. They have not recovered fully. I think over the next 3 5 years, the way India is structured, it makes tremendous sense to be in these intermediaries because these are float businesses. These are not lending businesses. They don't require capital to grow. As I mentioned, that is one of my constructs. We continue to take advantage of this current situation to build stronger sort of weights within this segment, which I'm pretty confident that will help us compound faster uh, over the longer term.
So, sir, these are the only three key reasons for the underperformance, and not much have changed in the portfolio after the recent correction or poor performance scheme.
So we may have, see, everybody took a hard look at their portfolios post, the negatives in the market, and everybody had lemons in their portfolio which they would want to exit, and we have done that. There were certain weaknesses in the portfolio. We have taken them out. Uh, Within the, as I mentioned, we had a power overweight. We reduced that, but we were not able to entirely reduce it during the peak. We have started adding back because they corrected enough. We added back. We had an OMC. We continue to have an OMC. We haven't changed our view. We also got impacted by the financial market exposure. The some of the stocks that had a financial market exposure. We strongly believe that these are good exposure to have over the next 2 3 years. And if India is indeed a fastest growing economy in the world, these segments will come back. And when they come back, you will have disproportionate return on these. Um, some of the sectors which we were overweight on earlier, we had exited. I mean, defense was one segment that we were very overweight on. We were able to exit almost completely before the fall. Um, I think for us, really, from here on, the key is uh, which are the segments that we are positioned for. We think we are rightly positioned in power. We think we are rightly positioned in financial markets. We think we are rightly positioned in large financials currently. Um, we are underweight IT. We want to sort of look at some of the names in IT, whether we can add. Right now, we can't find any value. Even today, after such a correction, we can't find any value as per the P mandate, which we would want to see more of. If you can find a little bit of more opportunity, you will see that coming back. We are currently running with about 6 or 7% cash to, uh, structure ourselves. Uh, Generally, we are not worried of, where we are. We also have built some exposure on the consumer services side in the recent past.
Sir, before I come to the next question, you spoke about, you look at the companies for 2 3 years in the answers. So is there your view on a company you do of 2 3 years, or you have a longer, in some companies you have a longer view of say 5 7 years also?
So we take longer views, but longer term is made up of medium term and short term. And if that continue, like for example, we have two exposures within the fund which have been running for 7 years. We have been taking some profits off the table, but because they were consistent in what they said, and we could, meet them every quarter or every 6 months, and we found them to be consistent and still growing, we held on. There's no point in changing something. Uh, so you try and see as an investor, the easiest thing is to find the best company and it keeps growing and your job is set. It's not so easy. Very few companies. So you try and see with a 2 3 year view and then take a view every year whether that thesis stands true today or not.
So if it continues to grow, then you are happy to
Yeah.
keep on investing in that.
Yes. Or at least hold on to what you have.
Okay. Now, sir, when evaluating a low P stock, how do you distinguish between a value opportunity and a value trap? What steps do you take to avoid companies with a deteriorating fundamentals?
So I think the over the years, I think this is one everybody has their own sort of definition on it. With whatever little experience I have gained in this, What I try and see is basic that anything which is value, that means the stock has fallen or has not performed versus the market. That's why it's value. So the only way you can think about it is the decline structural or is it only a passing cloud? If it's structural, whether the industry dynamics have changed, the management is sleeping, 10 other things, then you try and say that this is a value trap, don't go it even if it's cheap. It's not been growing to potential. However, if it's a passing cloud, the industry has not grown and you have not grown, or if there is a in between a cash flow squeeze, some misjudgment for a year or so, and then you take a hard call, can it come back? Does it still have? Then you say that this value can become valuable, and I'm happy to pay this value today, so that at some point this will become valuable. So that's one way to look at value. There is also a scale of value. Like I've realized that in hindsight only, you realize whether you bought a value stock or a growth stock. In a hindsight only, like 10 years back, had you bought a Jubilant Foodworks, you would have said, I'm buying a growth stock when you would have bought it. In hindsight, when you look at it, then you'll say, "Arey yaar, it was value. I bought a value stock at that time." So ultimately, it depends on where you bought it and what price, and that's where the context of value. So I've realized that ultimately value is something that you buy cheap for a growing business. That's what to my mind is value. Merely buying a cheap stock and it remains cheap forever, I mean, ठीक है, you will save face or save NAV for some time, but the NAV will not grow. The objective is for the NAV to keep climbing.
Right. So, the flexibility to allocate 30% of the Tata Equity PE fund outside the low PE mandate that allows for growth or thematic picks. So, how do you decide when to use this flexibility and what types of non-value stocks have you recently included? If you can share that with us.
So one of them recently in the last 3 4 months that we included and maybe added a little bit is in the consumer services domain, which we could not have bought in the value construct anyway because it's an emerging theme. But the consumer services theme is the only theme that is growing in triple digits in terms of revenue, and the size is just exploding, and you could not afford to ignore it. While profitability is still some time away, but it's doing its own thing. So we decided to really take a small bet within that growth because it's too big to ignore now. Uh, on the other bit, this 30% sometimes allows you that you have bought something very cheap and that value became valuable. What you wanted actually got achieved. But then you have this care, this can still grow faster and it's still in the right track. And I want to continue to hold it. So this 30% allows you that capability to have held on to this. And so there are two stocks that we have held on out of the two stocks that I talked about for 7 years. One of them still remains in that high value category and it's a 3% weight in the portfolio, and we are pretty too happy to continue to compound so that's one construct that we use. Otherwise there is no such okay, this is one sector that I want to sometimes what we try and do is that if the fund becomes too focused on 2 3 themes because of valuations, uh, so what we try and do is manage the other side where we have no exposure because of valuation and it's still doing well, and then we add, like for example, IT, as I said, is not looking that cheap even today after it has corrected, it has value, but in my P construct I can find only two stocks currently. I can add more. So I'm looking at some of them, whether can I use that to make this a well balanced portfolio. So you just do it for balance as well.
No, sir, how do you approach sectoral allocation and to what extent does the benchmark influence your decisions?
So it does influence in terms of it is just a sort of sounding board. The benchmark is just a sounding board. Okay, this is how. deviant you are from the original index. But that doesn't really stop you. If you're convinced on the idea, like for example, today we are slightly overweight versus Nifty 500 on the financial piece, but versus the Sensex, we are underweight. So which is fine if you are confident of the earning trajectory versus the Nifty or Nifty 500, and if that is better. Like currently we are underweight IT and underweight by a big margin. We are comfortable with that, but we are also aware that at some point in time we need to bridge that gap because you know uh, you are competing against the index in the end. And first job is to beat the index. Next job is to beat the peer. Those are the two large mandates. So you use that context from that. Generally, from a bottom up perspective, you want companies or sectors which are growing tremendously. Defense had no weight uh, in Nifty 500, say 4 years back, almost 1% or some number, and that became stupendous. So, and we had that exposure. The reason for very good performance in 22 to 24, defense was a big component of that. Power was a big component of that. These were all PSUs, by the way. And then that the tide changes, and you have to keep figuring out what's the new theme. And we had a extreme overweight position versus the benchmark. As long as growth is coming and you can justify it, it's fine.
Sir, now coming to the consumption theme, the consumption theme central to the India Consumer Fund has lagged in India for past few years. Do you think that the measure introduced in the recent budget will spark the consumption boom? If so, in which segments are you most bullish on?
So, in my opinion, this does give some relief, but I think the taxpayer has 10 other things to do. Consumption is just one of them. So I would not really look at this theme purely because of this. You should look at this theme for two reasons. One, India is a consumption nation, you know so there is a general tailwind of consumption, and that's why, and there are big quality companies within this theme. So you can choose to be in FMCG, you can choose to be in retail, you can choose to be in consumer durables, you can choose to be in auto anchs, and you can choose to be in media. These are the SID. As per the SID you can invest in. There's also 20% deviation that you can do versus the mandate. We don't buy lenders within this, but we try and see financial services, ticketing businesses, something else. uh, that allows it to make it well rounded. These are large market caps, these are liquid market caps, and therefore you can choose to become a little more diversified than a pure theme fund. That's why it tends to give that kind of well rounded return. In fact, every calendar year that you compare, last 9.5 years, the scheme manages to beat both the Nifty and the Nifty 500. So that tells you that it works, if you choose your bets wisely.
But sir, are you worried about the this consumption theme not picking up, household savings going down, household debt increasing? Is it a concern from a medium to long term perspective?
So it's a concern, but that's the construct of the world today, actually. If you see what are the themes today, that there are more haves than have nots. There is a wide discrepancy. And the fact is money pulls money. But that's the basic. So you have to be aware of it, and then you have to place your investment bets accordingly. Therefore, within the funds, we see for now mass market themes, we are out. We don't have too much exposure in it. We understand the stress there. But in a discretionary luxury, uh, you know, PLI, these are the circumvention themes that we have gone to. For now, we don't want to buy mass. Can we buy something that has allowed to do us to do better than the index and a lot of the peers as well. Going forward, as things improve on the ground, maybe there is a talk that mass theme will come back. Things are starting to improve. MSPs are up. State governments are giving more, to the mass segment. If that comes through and we see more green shoots, we will veer towards that. But for now, we continue to be where we are. We think the growth is happening much faster. Within mass, we like upscale, segments which are growing faster, which are able to capture market share. Uh, and we will continue to be there. I think the I do not believe that Indian consumption basket has come down. There was a lot of, in fact, if you remember last year, there was a comment made that the middle class is not growing and things like that. Now, the comment was made, from a company which is a four product company for the last 20 years. No change, no naya product. The customer has moved away. And, it's so one, your customer has moved away. There are regional brands that have cash flow, they're competing with you. So you also need to up your game and, add more. So many of these things are also market shares that have been given away because of lack of innovation. Those are also things that within, so India consumption basket has grown. The fact that Indians choose to, within a basic car that they ask today, their ask is a 3D panel. Even at a 8 lakh budget, they want that. So aspiration is very high. The manufacturer or the brand has to figure out how to, utilize that demand. And as things improve, market shares tend to come back, and you need to. This is like a every 20. I've been looking at this for 20-25 years. Every 2 years, 3 years, there is a new segment that comes in, and then you have to sort of chase that. But once you make within consumer, you start to make a dent to the consumer. The cash flow that comes to the shareholder is tremendous, and you cannot afford to miss that. That's the biggest re-rating potential you want to catch as an investor.
Right. Now, my next question, you did speak about it a bit, but can you please elaborate on how you balance the, managing Tata Equity PE funds focus on undervalued, low PE stocks with Tata India Consumer Funds, high valuation growth stocks, and what are the strategies that help you navigate these opposing styles?
So I think both mandates are crystal clear in what they want us to do.
Yeah.
The mandate itself helps you. If you're true to the mandate, it the confusion is lesser. So your brain is clear. Okay, this is what I need to do. Then you run your screeners. The universe for Tata Equity P Fund is much wider.
Hmm.
Consumer is much specific to, at least 80% is specific to consumer, and then you choose, and you choose wisely. Um, you I have realized that if you choose qualitatively better stocks in both mandates and you keep striving to do that, you tend to get a better result over a period of time. Sometimes you get it faster than you anticipated, sometimes it's long winded. And it's a there are times when it frustrates, the strategies don't work for some time. But if your homework is perfect in both, and your focus on, ultimately growth has to come in the P&L and cash flow, then whatever you're paid for will become more expensive at some point in time. And I think that's the idea. It is the mandate that allows you to keep it segregated completely, and that's the reason I've been managing both these funds for exactly the same time, about 9.5, 10 years, and both have given decent results. That means these strategies work.
So, sir, last thing before we wrap up this chat, during the market downturns, how do you adapt your stock selection strategy to ensure resilience while still capturing the upside potential?
So I think you try the best you can by reducing some bit of risk, or reducing what you call the beta that you have in the portfolio, uh, and try and revisit your thesis once again to see, in this scenario, whatever you hold, will it stand for the next 6 months? So there are themes that we believe in, but we believe that they will take the brunt in the next 1 year. Then we might want to reduce it, even if we have a longer term view on it, and then come back again to it after 6 months. But generally speaking, if you're sure of what you have bought, And qualitatively, you have done the right thing. Even if there is a NAV pressure in the entry, we question every logic of every stock during a downturn specifically. We have started to do even in an upturn that if something has gone up way too much in a short period of time, we want to take a view whether we want to own it or at least take some money out of it. It's a everyday process. It's an everyday process and that continues.
Right. Well, Sonam, thank you for sharing your insights there. It's been a pleasure speaking with you. Thank you.
Thanks, Ruchira. Thanks, Chirag. Thank you.
Thank you, sir. Thank you.